Good morning and welcome to the Homestead CPA. My name is Dan Snyder. For those of you who've been with us before, welcome back. For those of you who are new to this channel, welcome. Today we're covering part 14 in a 15-part video series on accounting, tax, and legal issues for homesteaders. You don't have to watch these in any particular order. You can pick and choose based upon the topic that you're interested in, but it does sort of flow together, and if you've got questions, you may find them answered in a different video. But welcome, and today we're going to be talking about something that is even further in the distance, which is estate planning and the use of trust and partnerships for homesteaders. Estate planning, Dan, I'm not dead yet. I'm not, retired or anything. What are you talking about? When you're trying to plan for your taxes and estates and things like that, the time to do it is when you don't have a lot. Obviously, we all hope to build up assets. We all hope to have things that we can pass down to our children. And you want to plan on that now so that you can minimize your taxes and maximize the ability to transfer assets. Now, I'm going to tell you right now in 2024, unless you have over $24.5 million worth of assets, the actual U.S. federal estate tax isn't an issue to you. And if you don't believe you're going to have an estate above that, then it may never be a problem for you. On the other hand, there's other issues. So for example, what if you want to sell your property? Well, we've talked about in the past keeping good records so that when you sell your property, you have the highest amount of cost. You've captured all the expenses, everything that you've incurred on improving your land, so that when you sell it, your gain is minimal to the extent that your property is your homestead and it qualifies for your homestead residential deduction. Then the first $500,000 if you're married, or $250,000 if you're single, of gain is tax-free. So assuming a married couple, you could sell your property, and as long as your gain is less than $500,000, there's no tax to be paid. In fact, you don't even have to report it anymore. So that is a benefit, and that is one of the main reasons I talk about keeping good records, because let's say you sell your property 15 or 20 years from now. Are you going to remember what you paid for it? Sure, you'll have a closing document, but what about those fences that you added? What about the stock tanks that you added? What about the road you put in? What about the new well that you put in? All of these things that you've done to improve your property are costs that can be added to the original purchase price, so that when you do sell it, it reduces the amount of gain that you have. But let's switch for a moment and talk about those of you who maybe you're homesteading on family land and you're like, Dan, we'll never sell land. That's just not something our family does. Okay, fine. How are you going to pass that land down to your children? Are you going to sell it to your children? Do you want to give it to your children? And what do you do if you have many children? So my wife and I have 6 children between the two of us. How do we get a fair value to each one of them? If they all 6 decide that when the second of us dies, that they're going to go ahead and sell the property and just split the proceeds 6 ways, fair enough. But what if there's 1 or 2 or maybe a grandchild that might want to live on the property? Well, you need to account for that so that you give those children the opportunity to purchase the land, but doing so in a way that's fair to the rest of the children. Another example, you may have a child that doesn't want the whole thing. Let's say he comes to you and says, Mom, Dad, I'd like to have an acre so I can build a house on the property. I don't need all your land. I just want 1 acre so we can build a house. Well, how do you do that in a way that is fair to everyone else? It's not fair to necessarily give him 1 acre and then give him his share of what's left also. You may want to sell it to him, or you may want to come up with a formula that says, all right, I'm going to give you the 1 acre today, but the amount that you inherit is, so for example, our case, 1/6, you're not going to get 1/6. You're going to get 1/6 reduced by an appropriate value for what you've already received. All of these are issues that you know because you know your children and you know who you want your property to go to and how you want it to go. That's why you need to talk to a good lawyer and make sure that your desires are met when the second of you passes. Now, family partnerships are very often used in these situations, especially where you don't want the land to be sold and or you already have sufficient children who have expressed an interest in maintaining ownership of the property, and you know that they'll be able to either buy out their siblings or otherwise be able to make sure that those siblings get their share of the use of the property and any profits generated by the property, etc. Now, as a side benefit of you not being here, when someone dies, when the assets that they have receive a step up in basis for income tax purposes. So let's say you bought your property for $300,000 20 years ago, and now the second of you passes and your children are going to inherit, and the property is now worth $1.2 million. If your children sell the property, how much tax do they pay? Well, the answer is zero income tax, because the property, which had a cost of $300,000 plus whatever you invested in it over the years, gets an automatic increase to the value as of the date of death of the second to die in the case of a married couple. If you're single, then it would be at your date of death. That's when the value gets increased. So generally, heirs don't have an income tax problem when they're selling real estate. What's the value? How do you determine the value at date of death? Real estate has a specific exception. Basically, if the property is sold within 12 months of the date of death, then the value as sold is going to be presumed to be equal to the value as of the date of death. Now, that's a presumption, and the IRS could come back and challenge that if there had been some significant differences. Let's say after you die, they discovered gold on your property, and now it's worth 100 times more, something crazy like that. Then, okay, now the IRS does have the ability to come back and argue that there's something that had an inherent value there. But for the most part, it's whatever you sell it for. Now, the family may not sell it right away. You may keep it for a couple of years, in which case you're going to want to have the property appraised as of the date of the second death so that you know what the value is in the future when you do sell it, if you don't have plans to sell it now. Plus, if, let's say, you are the child who is going to buy the property, A, you know what a fair price to pay for your siblings is, but B, you don't have to pay tax on your share of the gain either. So you get a step up in basis in your share, even though you didn't have to pay any cash for it. So there's a lot of issues like this. And when you put the property, if you choose to use a vehicle like a trust or like a family partnership to contribute the property to, what does that do? That allows you to get some of the increase passed on to your children, which may be a good idea, but it may not be, because to the extent they get an interest in the property today as a gift, when you die, there is no increase in value of that property. So most of the time, real estate is going to be held by some sort of family trust, which does not create an automatic gift when the property is transferred, but still allows for the step up in basis and allowing for children or child to continue to either own the property or buy out the interest from the other siblings. Transfer of assets at death is one of the most difficult challenges in my career. I wish I could say otherwise, but money and death tend to bring out the worst in people. So it's very, very important that you tie this down. You and your spouse have conversations with this, and to the extent you need to have conversations with your children about this, you need to explain to them, what you've done. Always tell them about it afterwards, and why, because it's important for them to understand. And if they all hear the same thing at the same time, and then they see it in the documents, it tends to have a restricting effect on people misremembering or people saying that, well, mom and dad always promised me the bottom land or whatever. No, put it in writing, make it very clear. And if you have to, if you've got enough land, you may go ahead and have that land platted. If you've got 3 children, you decide which portions of that land. You have it platted into 3 plots and basically say, I want plot 1 to go to this child, plot 2 to go to this child, plot 3 to go to this child. But if y'all decide you want to swap them later, that's fine, but that's where it's going to go to begin with. So these are ways to address some of the unpleasant issues that can arise. But by doing so, A, you will know that your children don't have to deal with this after you pass, and B, you'll know that you have maximized your flexibility in terms of transfers while minimizing the taxes that you or anybody else is going to have to pay. So with that, I'd like to thank you for joining us today. And remember, as always, even Jesus paid taxes.